expected to be finalized sometime 2010. In a similar study, use of insurance credit scores leads to more accurate underwriting of auto insurance policies in that there is a correlation between insurance scores and the likelihood of filing an insurance claim. The FTC report credit-based insurance scores impact on consumers of automobile insurance released in July 2007 also states that credit scores cannot easily be used as a proxy for a race and origin. In other words, credit scoring predicted risk for members of minority groups in much the same way that is predicted risk for members of non-minority groups. The Fair and Accurate Credit Transactions Act of 2003 directed the FTC to address the issue of whether the use of credit had a disparate impact on the availability and affordability of insurance for minorities based on a pool of consumers. The General Accountability Office has recommended that the consumer understanding of credit scoring and how credit histories are used, targeting in particular those with less education and less experience in obtaining credit. The Federal Reserve also studied the use of credit scoring, although looking at credit scoring to quantify risk posted by a browser rather than an applicant for insurance or a policyholder. The Federal Reserve said in a report issued at the end of August 2007 that credit scores were predictive of credit risk and were not proxies or substitutes for race, ethnicity, or gender, underscoring the FTC study. Insurance scores are confident ranking based on credit history information. They are measure of how a person managed his or her financial affairs. People who manage their finances well tend to also manage other important aspects of their life responsibility, such as driving car. Combined with factors such as geographical area, previous crashes, age, and gender, insurance scores enable auto insurers to price more accurately, so the people less likely to file a claim pay less for their insurance than people who are more likely to file a claim for homeowners insurance. Insurers use other factors combined with credit such as the home construction, location, and water supplies for fighting fires. Insurance scores predict the average claim behavior of a group of people with essentially the same credit history. A good score is typically above 76 and a bad score in below 600. People with low insurance score tend to file more claims, but there are exceptions within that group. There may be individuals who have stellar driving records and have never filed a claim, just as there are teenager drivers who have never had a crash, although teenagers as a group have more accidents than people in other age groups. Credit report information. Who wants it? It is becoming increasingly important to have an acceptable credit record, whether we like it or not. Society equates the ability to manage credit responsibility with responsible behavior, even if individuals have a bad credit record through no fault of their own. Banks and other Lenders look at the credit record of loan applicants so find out whether they are likely to have loans repaid. Some employers also look at credit records, especially where employees handle money, and view a good credit record as a measure of maturity and stability. In some insurance companies, underwriters have long used credit records in cases where additional information was needed before the development of automated scoring system. Underwriters would look at the data and make decisions, often erring on the overlay caution side. That is an advantage. Many more people automated insurance scoring and underwriting system eliminate the weakness inherent in someone's personal judgment and have allowed more drivers to be placed in preferred and standard rating classification, saving them money. With the development of these scoring models, the use of credit related information in underwriting and rating for many insurers has become routine. Insurers use insurance scores to different extents and in different ways. Most use them to screen new applicants for insurance and price new business. Why insurers need it? Insurers need to be able to assess the risk of loss, the possibility that a driver or a homeowner will have an accident and file a claim in order to decide whether insure that individual and what rate of set for the coverage provided. The more accurate the information, the closer the insurance company can come to making appropriate decision. Where information is insufficient, applicants for insurance may be placed in the wrong risk classification. That means that some goods drivers will pay more than they should for coverage and some bad drivers will pay less than should. The insurance company will probably collect enough premium between the two groups to pay claims and expenses, but the good drivers will be subsidizing the bad. By law, in every state, insurers are prohibited from setting rates that unfairly discriminate against an individual, but the underwriting and rating process are graded specifically to differentiate good risk from bad risk. Since insurance is a business, insurers favor those applicants that are least likely to suffer a loss. One of the key competitive aspects of the personal lines insurance business is the ability to segment risk and price policies accurately according to the likely cost of claim generated by those policies. Insurance scores help insurers accomplish these objectives. Earthquake risk and insurance issues. An earthquake is a sudden, rapid shaking of the earth caused by the breaking and shifting of rock beneath the earth's surface. This shaking can sometimes trigger landslide, avalanches, flash floods, fires, and thus names. Unlike other natural disasters such as hurricanes, there are no specific season for earthquake. Earthquakes in the United States are not covered under standard homeowners or business insurance policies. Coverage is usually available for earthquake damage in the form of an instrument to a home or business insurance policy. However, insurers that do not sell earthquake insurance may still be impacted by these catastrophes due to losses from fire. Following a quick, these losses could involve claims for business interruption and additional living expenses as well. Cars and other vehicles are covered for earthquake damage under the comprehensive part of auto insurance policy.